Venture Capitalists Decoded. Getting the working capital you need to grow your company doesn't have to be too hard. Lots of businesses these days turn to venture capitalists. These options can work for startup ventures, but there are details you should know. What is a venture capitalist? According to Investopedia, a venture capitalist is an investor who either provides capital to startup ventures or supports small companies that wish to expand but do not have access to equities markets. Venture capitalists are willing to invest in such companies because they can earn a massive return on their investments if these companies are a success. What are funding stages? Venture funding comes in stages and not all at once. Usually, there are 6 stages. These more or less correspond to the stages of a company's development: seed, startup, growth, Series A, second round, aka Series B, expansion, and bridge. Seed funding represents the earliest round of financing needed to prove a new idea. Funding often comes from angel investors or, lately, equity crowdfunding. Startup funding comes when early-stage firms need funding for their expenses from marketing and product development. Growth, Series A round funding, is for early sales and manufacturing funds. This is typically where VCs enter the picture. Series A is essentially the first institutional round. Here is where most companies will have the most growth. Second round funding is for working capital for early-stage companies which are selling product, but not yet turning a profit. Expansion, also known as mezzanine financing, is expansion money for a newly profitable business. Bridge financing is when a startup seeks funding between full VC rounds. The aim is to raise smaller amounts of money instead of a full round. Usually, the existing investors will participate. VCs usually leave via a secondary sale, an IPO, or an acquisition. What are the differences between angel investors versus venture capitalists? Angels are not quite the same as venture capitalists. An angel investor will typically invest in early stage or startup companies in exchange for 20 to 25% return on their investment. Angel investors tend to invest less and will also want less control than venture capitalists tend to do. Let's recap for Venture Capitalists Decoded. Venture capital is a fairly new method of investing. VCs invest in startups which they think will turn a profit. They often look for companies and industries they know. They are more amenable to higher risk industries. Usually, they invest more than angels do. Funding comes in well-defined stages. VCs want a piece of the business and often a seat on the board of directors. Contact us today to learn more about Venture Capitalists Decoded.